Hello, Smart Money Tree podcast listeners. Welcome to the show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with my good friend Doug Hayron. Hey, Doug.
Deja vu all over again. Good to see you.
Thank you, Yogi Berra. Uh, yeah, I'm feeling pretty spicy this morning. Got my ice bath in, and I know we talked about it last week, and I'm at it again. I've been doing it all week, and I feel like $1,000,000. I wish I had $1,000,000, but I feel like $1,000,000. So maybe the ether will make it appear because I feel that good. But yeah, I'll say I'm still doing that, and my family thinks I'm crazy. I feel great, so maybe I am crazy. We'll see. We'll see. The listeners can judge. But anyway, as we kind of dive right in here, we wanted to, a lot of stuff has happened in the last week. Certainly, the Democratic Party has gotten behind Kamala Harris. The convention is still to come, so it's not 100% certain it'll be her, but it's probably 99% certain it'll probably be her. And it's interesting because at the moment it's somebody that the people didn't technically vote for. They voted for Joe Biden to be the candidate and end up being Kamala. So that's an interesting turn of events. So we'll see what happens there. But she's come out to a strong start, and seeing every time I watch YouTube, I see her commercials. I can't get her off the screen. I'm like, please stop showing me this commercial. Like, I don't want to watch political. I don't want to watch political ads. Thank you. And
Good luck to you on that one.
yeah, I know.
Yeah,
I know. This is my favorite. My favorite part of every 4 years is like watching the presidential fight, like the debates, the advertisement, like the commercials. Like it's all very interesting to me. But at the same time, I hate it because it's like Kamala, please stop advertising to me. Like I've seen your ad. You're begging for money. Like I don't want to see it. Like I haven't seen one from Trump, so I don't even know what they look like. But I'm happy to not see ads, period, but I certainly don't want to see political ads, and that's all you're going to see for the next 3 months. So I'll be happy when that part's done. However, we are entering that season, and it's going to be once again a close race. Even if it's not, they're going to tell you it's a close race because that's how people watch TV. If you said one side's going to blow out the other side, no one would ever watch TV and watch the ads and all the stuff. So personally, I'm done with it all. But I did want to start the show with a chart crime, and it's a chart crime, but at the same time, it's also partially in jest because
it's a chart crime parody.
yes, that is a good way to describe it. It is a chart crime parody, and here is the chart crime. And it's the distance between Neptune and Earth correlates with the remaining forest cover in the Brazilian Amazon. It shows the correlation as being 0.973. Wow, that must mean one equals the other. Well,
Neptune is getting closer and closer and closer this entire time as we've seen less and less forest. I mean,
it is correlated.
I see it, don't you?
I see it as well. The data is very clear in this chart, Doug. And I'll tell you, if I'm looking at this, I'm thinking eventually, if Neptune keeps getting closer, we're not going to have anything left. That's scary. Maybe we should all be really scared. Well,
thank goodness is when Neptune starts moving away, the Amazon rainforest is going to automatically repopulate itself.
Yeah, and based on the distance on Earth and Neptune, that could mean that the Amazon rainforest could take up the whole world, maybe even other planets, because it'll be so big. Anyway, we bring this up as once again a chart crime in parody, but still to prove a point. There's a difference between correlation and causation. This is correlation. And there's a good site, I forget what it's called, but I found it years ago. And it basically shows a bunch of unrelated things being correlated. Really, really high correlation, even more than this. And people believing, and if you believe that, then I got a bridge to sell you. But the point is sometimes there can be a lot of correlation without causation. And we have to be really careful about the difference because sometimes it's hard to tell. Science, it's hard to tell. The reason that you do science the way you do science is because there can be some high correlations, but it doesn't necessarily mean it's causative. So the way science works is somebody comes up with a theory, they try to prove it, they come up with some way to prove, they do an experiment, and they quote unquote prove it, right? And I say quote unquote because the proving it is really just the first round where they say, I can't debunk this. Then they send it out to the scientific community, and then the scientific community of trolls, I say this in air quotes because they're not really trolls, but they act in the same way. They basically try to troll this experiment. They're like, oh, this doesn't work because of this. And their job is to try to disprove it. Now, I say that in air quotes because they're not really trolls. They're good people doing good work, but they're basically trying to disprove this theory. They're trying to poke holes in it and say, well, what if you do it this way? What if you do it this way? And if one person, if a single person can disprove it, it is no longer a valid theory, right? That's how science works. And if no one can disprove it, it means one of two things. Either A, it's true, or B, it's no one has disproved it yet. Now, there's a small bit of difference because it could take 100 years to disprove it, but we accept it as truth until it's disproven. So science is a really interesting thing where the community is based around the fact you're trying to disprove something that somebody created. And if everyone agrees, like, no, this is valid, like we can't find a way to prove it, then it becomes accepted fact. And so when you're looking at data, it's very common in the financial markets that people draw conclusions. Hey, here's this and here's this. And, every time that the yield curve has been inverted, it leads to a recession because 10 out of 10 times it's happened, except for this one time, which it hasn't happened yet, in air quotes. Now,
Kurt,
go ahead, Doug. I know you got
no,
to smile.
when you're done, please.
Okay.
I have got something funny to say on this.
Okay. So when you think about the correlation versus causation, I look at like the inverted yield curve as a correlation because if you think of the causation, well, how could it one lead to the other? Well, I guess if you had an inverted yield curve, it means banks are not making money on lending, which means they're not lending, which means they're not creating a money supply, which means the economy is not expanding, which leads to a recession. So logically, it makes sense why that would happen. However, we have a completely different economy than we had 30 years ago, which banks are really no longer lending. They're just putting their money in treasuries and borrowing from the Fed, and they're really not even lending much money anymore. So the money is no longer being created by the banks, it's being created by the Fed. Hence, it's kind of broken the correlation in my mind. It doesn't mean it doesn't work. It just means in my mind, it's no longer the thing that used to be as an indicator. So it might still be correlated, but the causative effect might be broken or at least damaged. So you just have to be careful about how you think about these things because sometimes you may never know if it's correlated or causative. Sometimes there is no way to find out, and you just have to go with the data and just say probability wise, high probability chance, low probability chance, and such. Go ahead, Doug. I don't want to keep you from your joy here.
This is great. So I did a little bit deeper digging on this chart. It was posted here, as you can see online. Tyler Vigen, I don't know if I'm pronouncing.
Yeah, he's the one I think did the original one. Yeah,
correct. Spurious correlation. Here's the thing. I got to give credit where credit's due. So Tyler, this website is dedicated to the creation of chart crimes. That's exactly what it does. So it's got, what it produces, which is hysterical, is all of these different correlations based on real data, then provides an AI explanation to validate the information of the chart. And then it actually produces an AI academic paper justifying the outcome. So listen, what I'm saying to you, Kirk, and to everybody is we're going to have a lot of fun with this. And I have a feeling this may become one of my new great websites. But I do want to say that as you were talking, I found another incredible correlation that we need to look out for, that according to the Energy Information Administration, between 2004 and 2021, the volume of kerosene consumed in Cuba in millions of barrels per day plummeted. At simultaneously at almost a 0.984 correlation, relative volume of Google searches for CIA hotline on Google Trends. So they really lined up perfectly. The AI explanation is that clearly there's a case of spies being left in the dark, that as kerosene supply in Cuba has dwindled, Cuban spies had to cut back on their clandestine activities. This is great. We're going to have a lot of fun with this because we love chart crimes, and we think we have found the gold mine for being able to enjoy the the parody around just the stupidity of so much stuff that gets posted online in order to create narratives. So, look forward to continuing to have this conversation week to week. So.
Yeah, and by the way, this is the website I was referring to. I forgot the name. Spurious Correlations. It was tylervision.com. Spurious Correlations. This is what I originally found, and he's expanded on it. I actually need to spend some time on this because he's expanded on the original one. The one that I love, it's divorce rate in Maine correlates with the per capita consumption of margarine. It's like, well, I can see that one. There's something there, but how about here it is. Amazon's annual outbound shipping expenditures in millions compared to Google searches for cute cats.
Yes.
And I'll do one more and then we'll kind of move on just because I don't want to bore everybody. Here's another one I saw is where is it now? Oh, UFO sightings in South Carolina correlates with the popularity of the first name Annabella. Like totally ridiculous, but very, very funny. So
the best part about it is the AI generated research paper that comes out with it. So this is incredible. For those of you who want to have a little bit of fun, that have the same type of sense of humor that Kirk and I, you should check out this website because you can literally click on a link on the website that will take you to view another random correlation. The one that I found about kerosene use and CIA hotline was Spurious correlation 1,102. So we are talking about thousands of these correlations out there, each with AI explanations and research papers to boot. So this is good. Again, it's a rabbit hole that, depending on your sense of humor, have fun.
Yeah, it's funny. It's interesting that you're saying that these are random because I'm definitely not seeing the same ones, which is kind of cool. So you can see a whole bunch of them. So kudos for Tyler putting this together. I'm gonna have to contact him. I've loved this stuff. I thought he put up the site when he was in college years ago. I think it was probably like 7, 8 years ago. He was in college. He put it up, and now he's like still doing it. So kudos to him, man. I big props for a guy who's. I will say this one thing about the internet. The internet has become a cesspool of garbage, but the one good thing that has come out of it is humor. You know, in the past, there were comedians. You had to do stand up, and there was a certain form of comedy you had to do. But now with the internet, with memes, with all this stuff, it's like, how would life be as vibrant without the amount of humor out there? Now, I've heard that 30% of people don't have a sense of humor. So if you're one of those people, I'm sorry to hear that because life is so much better with humor. But you know, people with a sense of humor, like, this is just funny. Like, even if you don't agree with it, it's like, all right, that was good. Like, I know you're poking fun of something I believe in, but damn, that was good. Like, you know, some people just, they have it. And so when you see these things, you know, I don't like going down rabbit holes in the internet because you just waste enormous amounts of time, but it does have value sometimes when it makes you laugh. So I live in the great state of Massachusetts. I may be the only one who calls it that, but I digress. The great state of Massachusetts has a commercial funded by the state that says you can't win the lottery if you don't play. For the moment, let's ignore the fact that there's a state-sponsored commercial suggesting that you go out and spend your hard-earned money gambling on lottery tickets with odds of over 100 million to 1 of winning. But it's true, you can't win if you don't play. I'm giving you the same opportunity here in the show. The only difference is I'm not asking you to buy a lottery ticket. I'm only asking 5 to 10 minutes of your time. But I will pay you at least 100 million Zim dollars for your time. We do have some foreign listeners, so if you don't like Zim dollars, we may have some other currencies as well. If you want to earn over 100 million Zim dollars, go to www.moneytreepodcast.com/free money to get your free money today. Moving on, I want to get to real estate this week because we talked about it last week, and I know the market is melting down as we speak. Well, it hasn't gotten worse, but it's certainly a bad day.
For the day. For the day.
It's been a weird week, but you know, for the day, it's good. It's a bad day for today, but yesterday was good, so it's, you know, it's hit or miss. But anyway, I don't want to spend too much time in that because right now it's bouncing around a lot, and it's some of the things are not good. But anyway, if we're looking at, I want to mention a few things, and I want to get into data centers, I want to get into real estate. But the first thing I want to talk about is the size of markets. Now, I'm bringing this up because we frequently talk about stocks. Everyone does because they're interesting. No one talks about bonds. We do, but they're also not interesting. Very few people talk about commodities because they're downright boring. Um, but here's the thing: the bond market is $130 trillion of value. 130 trillion. Now, I don't know how much debt and I guess you could say government obligations our government has, but I think we're creating another $1 trillion of debt every 9 months, maybe less, maybe 90 days. I think it's 90 days.
I just saw that it only took 4 days to add a new $100 billion in debt. Four
Yeah, I
days.
think it's like, yeah, I think the average is like around 89 days. We add another $1 trillion to our debt. So 130 trillion is the size of the bond market, which obviously is increasing because debt is a bond. Now compare that with the stock market, which is only 50 trillion. 50 trillion for the entire US stock market. That's all the equity, which means there's a lot more debt than equity out there. There's almost 3 times as much debt than equity. Then you've got the total global stock market is $100 trillion for perspective. So we are 50% of the global stock market amount. So basically, if you look at that, you're looking at, if you take all the stocks, they don't match the bond market. Now, looking at other assets for comparison, gold is 16 trillion, silver is 1.5 trillion, Bitcoin is 1.3 trillion, which is very close to the size of the silver market. The total crypto market cap is 2.4 trillion. Now compare that to the bond market of 130. Now, I'm not even talking about the Forex market, which gets into the quadrillions. That's a little bit different. But I want to say this in terms of context because bonds are really important. Like that, the bond market moves everything else because everything in terms of size, the bond market dwarfs everything else. I mean, look at the fact that Bitcoin is the same size as the silver market. The silver market is not big, right? It never was. And people always say, well, silver's going to the moon. It's undervalued. Yeah. I've heard it before. And I don't disagree. But at the same time, why isn't it doing that? It's an industrial metal and people don't use it. So people like gold. They don't like silver so much. So for whatever reason, you could say it's manipulated. I don't know the answer to that. Neither do you. So I don't like to talk about things that are undiscernible. So if you say it's manipulated, I say, great, prove it. I don't disagree. It seems manipulated, but I can't prove it. Neither can you. If you can prove it, I'd love to see it. So, I don't like to talk about things that we just make up in our heads and we think are through. I like to see data and data that's provable. So if you look at, the gold market, the silver market, they're dwarfed by everything else. So just understand that bond market is going to keep getting bigger and the stock market is getting bigger until we hit a recession. But I think it's good just for context. Now, I want to show this chart and I'm going to hand over to Doug to talk about real estate a little bit. So we talked about before data centers. Now, there's some really interesting data that's come out recently. And we talked about last time on how the amount of data centers is skyrocketing because of the need for more data. AI is going to dwarf the amount of data centers that we have. Like the need for it is going to dwarf it relatively quickly. Like this is going to have to go exponentially higher to meet the need for AI. Now, if you look at worldwide, this is where it is. We have an enormous amount. And of course, we're kind of the global hub of technology for the most part. So there's a reason for that. And we talked about before, there's a massive amount of energy that is needed for these data centers to run. And Silicon Valley is scared because we don't have the energy to meet the need. So one interesting thing that's come out in the last few weeks is there was a survey of CEOs done in the last few weeks that said that they don't see how AI is going to impact their business in the near future or if at all. It seems I don't have this in front of me, but it seems to be more of a nice to have than a need to have. And they don't see how it's going to move the needle in a profit center perspectives. So they don't see that they're going to need to invest heavily into AI at the moment because they're just not going to see it's not going to turn a profit for them. So why invest the money? That is the survey of CEOs recently, which is an interesting take compared to everyone else who's saying AI is going to eat the world, which it may, but the CEOs aren't seeing it. I'm not seeing it. I think it could get there. We're not there yet. Like I've said this before, it's a really interesting toy. It's going to eventually change the world. We're not close to that yet. A lot needs to happen to get there, and we're just not close enough. So, does it help in certain things? Absolutely. There's certain things it's great at, and there are other things it's terrible at. But if the CEOs aren't seeing it, it means it's not being widely adopted yet, which means that there's a lot more upside. And it also means that potentially the bubble that has been created around AI stocks and AI trend in general may be a little bit early, and we might see kind of a big pullback before it finds its equilibrium and starts to rise again. So if I'm a betting man, and I'm not, I would be waiting for the AI trend to blow up, and then wait for it to resurface with stronger fundamentals. The same thing happened with cannabis. If you guys remember cannabis, everyone wanted to invest in cannabis stocks, yet none of them were great investments in cannabis. Right? You're basically investing in a commodity, and commodities are bad investments. So there was like 2 or 3 stocks, and they bubbled, and then they crashed. Everybody lost a lot of money, and they still haven't really recovered. So you have to think about with sort of new trends, like what are you going to do when the trend turns? Are you going to get out? Are you going to wait till it quote unquote comes back? In my opinion, you should have a stop loss, ride it out. If it's a stop loss, you're out, and just be happy that you made a good amount of money and move on. Or if you made 100% return, which wasn't hard in some of these AI stocks, you made 100% return, sell half, take your money off the table, and let the rest ride. And you have no risk because you've taken your initial investment off the table, which means you have no risk in that investment. You can let it do whatever. It could go to zero, it could go to the moon. Either way, you're going to participate. It's a great way to manage risk. Doug, what are some of your thoughts here on you know what? I just realized I wasn't sharing my data center chart on the amount of data centers in the US, which is 5 times the next amount, which is Germany. Huge amount. I'm sorry, 10 times. What am I saying? 5 times. 10 times the amount of Germany, which has 500. We have 5,381. So huge difference. Go ahead, Doug.
Yeah, and and a part of remember that a lot of the things you have to think about with these data centers too. A lot of them are not individually owned. A lot of the data centers are owned by a company that does data centers and then rents out that space to various companies. A lot of them are basically white boxes so that you don't know what they are, so that it doesn't become an obvious source of an attack on that data infrastructure, et cetera. And let's come back to the, when we compare the number of data centers in the U.S. compared to all of the other countries on here, possibly with the exception of maybe China and Canada and Russia. I mean, I guess we could include in Australia as well. But one thing that the United States has a lot of, and it has a lot of cheap land that is, relatively cheap land that has been, for commercial zoning to put a lot of these things and build them on. Right. So that certainly helps it to be a great destination for the building of these things. So, understand, I don't know the reason that the United States has become, the place where more and more of these have exponentially been grown. But for a lot of it's because it's basically becomes the world epicenter for building these types of structures. Now, that correlates to other things. There's another image in there is like Microsoft, just to kind of show you what, going back to your comment about CEOs. Microsoft expenses, because it's spent a lot of money on these data centers, hoping to capitalize for this cloud infrastructure demand. But again, to build these data centers, you're hoping that there's going to be a surge of demand to you, for the purchases of that space and that usage on your data center. But there's a cost to having that. It's a rent. You build a property. The goal is to rent that space out. It takes a lot of cost and infrastructure, which again, this ties back into conversations we're going to have about real estate. 2016, you are looking at somewhere around $10 billion in expenses on these data centers in just an 8-year period. That has compounded at roughly about 500%. And you're looking at from $10 billion to 50, actually closer to 60. So almost a 600% increase in the cost just to maintain these. Now look at what's, so Silicon Valley has a high expectation of the implementation of AI. You mentioned the CEOs are coming back saying we're not seeing it because the CEOs are looking at their bottom line and looking at the expense. So it's one thing for Silicon Valley to say this is the wave of the future. It's another thing for a company that has relatively fixed revenue to look at how they allocate those resources internally. And they need, when they are looking at how to allocate those resources, they're always looking for a risk versus return, a cost versus return. Shareholders are not patient. They do not care about an investment in AI if it's going to be 10 years out where there's going to be a profit from it. They want those companies to have that profitability soon. So infrastructure, the financial, the CIO and organization of a company is always considered it's considered a loss, right? Unless they can sell that out, it's considered a loss. So these CEOs are looking at this, say, how do we get this return? Going back to the stock market, the bond market is huge. It tells you going back to what you said, access to capital is critical. Most things in this world are being built off of bonds. Okay. Yes, banks are there lending, but in many cases, the bond market is where a lot of companies and governments get their financing. Every time you pay a toll, most of the taxes you pay for schools and such, those are bonds, right? So there's the public sector. Corporations are doing the same thing. Okay. So that's why it is as big as it is. When you talk about the cap on the size of the stock market, 30 billion or 30 trillion, comparatively, it's no different than when you think about investing in the microcosms. So look at it, you invest in the Dow, it's only 30 stocks. You invest in the S&P, it's only 500 stocks, really manipulated by about 7. Okay, so when all of this money, so these, you see also the difference we've talked about before between how bonds are it's very calculated. Okay, it's tied to mathematical returns. Let's go back to this AI and this data center focus for a second. Hey, stocks of companies involved in AI have blown up. Microsoft, blown up. NVIDIA, blown up. Okay. A lot of that is, what do we expect? We're excited. This is the future. But what happens is then there becomes the reality. And the CEOs are telling you right now that reality is much more tempered, which means that where a NVIDIA went, where a Microsoft went, in comparison to now the revised outlook of what they could continue to make, if you're starting to hear a pullback on that expenditure, that's why it is a partial correlation of why you're starting to see that pullback, especially in those bigger appreciated stocks like NVIDIA, because there may be a reality setting in over expectations 3 months ago. There's only so many of these chips are going to sell. And of course, that's going to be tempered if businesses are starting to see a slowdown in other areas or not going to be able to articulate a return to their shareholders in a short period of time equal to the expectations. So moving on, though, the data centers back to real estate. Okay, we are starting to see a lot more pressure and fallout of the rising interest rates or other variables that have occurred in the real estate market. I'm going to stay on commercial for a second. We just saw the other day another example of a building that was purchased for over $300 million in 2006. That building just sold an auction for $8 million. $8.5 million. I want you to take a moment here and do the math on that in your head. That's bad. You're talking somewhere in the range of a $320 million loss to whoever bought that. Okay. And we're starting to see more and more of these stories out there. The commercial real estate space, it's not going to affect everything, but it is affecting a lot. Okay. Because they're not getting again, the value of that building has to do with how much can I rent space in it for. And the rents have dropped. More people are home. They're just not going back at the same levels that we had. On top of that, you look at financing. Commercial financing is very much variable. It changes regularly. So if there is any financing on these commercial properties and these rising rates, it has put tremendous pressure on the cap rates these things can command. Okay. Businesses are looking at how they can cut costs. Rent is one of those things. And if we start to see a continued softening, there's going to be more and more pressure on that. Taking it to the residential side of things, people are feeling it there too. Okay. Depending on where you live, like where I live in Minneapolis, it's been pretty resilient. Especially you go along the North Shore, you look at the suburbs. There's still been a fairly positive transactional, a transactional outcome that's come from housing recently. But in a lot of areas, especially deep south, we're starting to see 25% rate cut or price cuts in places like Florida. We're also starting to see across the board, a lot of people over the last 4 years took on a lot more, took on new properties, new purchases at these higher rates. It has now hit approximately 40% of the regular of the cash flow of an average house is the average now being spent on property, on housing. Now, again, this is something that is this just tied to the mortgage payment. 41.4% of the median U.S. income is being spent now on a new mortgage on the average, okay? In 2008, that metric topped at 39%. So that is, extremely high pressure on the families that take out a new mortgage. And that is going to contribute to the slowdown. On top of that, you got to look at the people that are still sitting on the 1% and 2% and 3% that, again, are less inclined to move now because they're going to see all of a sudden, if I sell this, I'm going to be in a position where I'm going to have to take on another mortgage at a higher rate. But we are starting to see a spike in certain areas. For example, Texas and Florida, the housing inventory, especially in places like Austin, have skyrocketed to the highest amount that vacancy that has happened, at least going back over the last 6 to 8 years. Again, I would call this a little bit of a chart crime on one of the charts we have on this is apartment vacancies, sorry, not housing vacancies, but apartment vacancies. They're showing a 9.3% vacancy. It was 8.4 in 2016. Well, I mean, hey, what was it before that? I would like to know. But we are starting to see, that, rents are starting to go up. And remember, people own these apartments. A lot of people dove into these apartments and took these on as second properties or investments, thinking for short-term or long-term renting. And again, this has been sold for the past decade or so, even longer than that, especially when you start getting into the rich dad, poor dad mentality of, going out and buying real estate. And I like to make sure people know that in the book, he didn't say real estate was the thing you should latch on to. He said it was for him. It's going to be different things at different times, but a lot of people latched on that you have to have real estate as a key to wealth. Well, now if you're one of those people that has that real estate, depending on when you acquired it, and you are not getting renters in there, that is an exceptional burden of cost to management. It is not cheap. I saw something today showing if you had $500,000 in stocks, what is the cost to own those $500,000 in stocks? It's zero. If you have $500,000 in real estate, there's a fantastic amount of cost. Not only the mortgage interest, but you've got the utilities. You're mandated on keeping those utilities, whether somebody's in there or not. You've got property taxes, which are going through the roof, somewhere in the range of 40% increases in certain areas on property taxes. And that also, and then you've also got the increase on insurance that's happening, in a lot of places that, I saw someone the other day and it just baffled me, Kirk. And I sent something to you about this because people are out there clamoring for research. This day and age, people are listening to shows like this because they want information and they're doing more research. But the problem is, where are you getting this research? I watched someone who's got 27,000 followers on Twitter who gives regular financial advice, who just went out and posted, hey, again, because the people see his tweets and follow him as an expert. Let me ask you a question. Would you consider someone an expert that doesn't understand this basic answer? He said, I bought a house with a fixed mortgage, but I just got told that it's going to go up by double because of an increase on my escrow. Does this seem right to you? I thought it was going to be fixed. Now, how does an expert, in quotes, on social media not understand how property taxes and insurance works? And he didn't have a basic clue about the fundamentals of escrow. Just because this has been sold that if you buy real estate, I mean, Dave Ramsey likes to say nobody's ever lost a house that didn't have a mortgage. That isn't true, because you're still going to have the continual cost of burden of maintaining the property that's tangible, like real estate. I'm sorry, like property taxes and insurance. You're also going to have the intangibles. You can't not fix your foundation. You can't not fix your AC. You can't not fix your roof, which, hey, hopefully got hail and maybe the insurance will pay for that. But then they already got you on your insurance, on your increase in escrow. People are feeling the pinch whether you have taken out a new mortgage at new rates or not. And as we start to see non-farm payrolls and other types of data coming out, that's continuing over the last 5 to 6 months, they've continued to rise and revise an increasing number of negativity around unemployment and employment rates and what that really means. Guess what? You're going to have a job in order to be able to pay these things. So, again, this is going to be very regionalized on the pressures of vacancies, but we are starting to see people that are feeling that pressure. And that's why we're starting to see new homes for sale. And look at what's going on in the South right now. If you look at what they're expecting into 2025, 250,000 homes are being shown for sale in the South, according to the U.S. Census. Now, the last time we saw that level was 2020, okay? But this has been rising steadily with a little bit of dip since basically right around, 2013. But we were way below what happened in 2008. We've now surpassed 2008 in terms of housing available in the South. And why are they selling? I mean, if they were financially healthy, Kirk, why would they be selling in a market like this? Something is telling you that they are either trying to get out early because they're concerned about what's to come, or they're already feeling the financial burden of pressures of inflation and rising interest rates that's causing them to have to make this decision. But unfortunately, once you flood the market with availability, that just creates more pressure for you to have to make a price cut in order to be able to be noticed. In certain areas, gone are the days of the, hey, I posted and got 27 offers in day one. And I think that's created a very, the word I'm looking for here, I think because that was going on for so long, that created a very big ignorance to the impacts of what can happen with real estate when the fundamentals change. We're starting to see it.
Yeah, thanks, Doug. And we talk about real estate. We haven't talked about real estate in a while because honestly, there really wasn't much to talk about. The fundamentals didn't really change that much, and yes, they're not good and they're not getting any better. But we don't want to beat the dead horse every single week. So, so I appreciate you kind of sharing that with us, Doug, because I think we'll be talking about real estate more. In part because of the news this week. I'm going to share a few things here. So one is this is a good tool, the CME FedWatch tool. So it kind of shows probabilities of, see if I can expand. There we go. Probabilities of rate ranges for future meetings. So as of right now, it shows that the probability is about 70% of the rates dropping. I think it's 50 basis points. And I think it's what I found, and we've talked about this in the show, last year at the end of the year, people thought we'd have like 17 rate cuts this year, which is crazy. And
we didn't think that, Kirk, but for some reason
we didn't think that. There was a big bank that thought that. I think the average was like 9 rate cuts, which is still ridiculous. We said to be 0 rate cuts, maybe 1. And the way it's looking now is, it's kind of fallen into place, because is there going to be one in September? Maybe. There might be one. That would be probably the only one I would expect. And then after that, would there be another one? I mean, there's no reason for them to drop at 50 basis points. If they do, if they legitimately drop 50 basis points in September, I'm going to call foul on politics. You got an election coming up. There's no need to drop at 50 basis points. Now, if the markets crash, I I take this off the table, right? Because the Fed typically, if the markets crash, one of their tools is to drop rates quickly. So if that happens, I completely concede the case, because the Fed pretty much does emergency measures and they're going to do whatever they want. Withstanding that, anything more than 25, I think even 25 would be a stretch, but anything more than 25, I'd be a little bit cautious. To say that that's going to happen, I would probably bet against that. I still think it's quite possible we don't have any before the end of the year. I think Wall Street's getting ahead of itself. The Fed has alluded to the fact that they're going to be dropping rates soon, which doesn't really mean when, but maybe September. Let's say 25. Out of the whole year, I'd say the probability is 25 in September and no other time. Now, I don't see a recession, even though the markets are bouncing around, which, by the way, is most likely due to the fact that people are repositioning their portfolios around the fact that they might drop rates. Now, if you look in the last few weeks, small caps have skyrocketed. Maybe not today, but in general, they've skyrocketed because people know that as rates drop, small caps should do better. And small caps have underperformed large caps for a long period of time. And so people think, hey, this is a great opportunity for small caps. Then they might be right. But at this point, I think Wall Street's getting ahead of itself, and I'm not going to jump on that train. I think that's just speculation. We'll see. But I am curious to see how the Fed reacts, because we have a rip-roaring stock market. We have a cooling inflation market, right, where the inflation's coming down, noticeably coming down. It's not coming down in the sense it's going negative like deflation, but it's they call it disinflation when it's coming down at a or it's going up at a less increasing rate, right? And I don't know why I can't come up with a word for that, but at a rate that's not going up as much. So if you look at how this kind of operates, we haven't hit deflation. We're kind of in disinflation. It's been that way for a while. People feel comfortable there. We have higher rates. The higher rates haven't changed the stock market. So why are we changing it? Why are we changing rates? The stock market's still high. So I've always suspected that coming into this election, either going into it or right after, we're going to see some sort of stock market, volatility, meaning, I got to put on my tinfoil hat. I'm not going to put it on now, but I have a theory that depending on who's ahead, then the markets might change accordingly. But, that's my tinfoil hat. I don't really put any serious money on it. It's just more of in the back of my mind. I'm thinking, all right, as a scenario, how would this play out? So one thing you need to know is, and we're going to wrap it up here in a minute, is that when you're looking at the markets, you have to look at scenarios. So I look at all scenarios, even the tinfoil hat scenarios. Do I bet on that? Not always. I mean, sometimes it makes sense, but generally you have to look at all the scenarios, even if they're detestable to you. Even if it's like, for instance, like George Soros bet a lot of money when Trump and Hillary were going against each other for presidential election. He put a lot of money on Hillary winning, and he was wrong. And he quickly changed his tack and sold positions and went the other way. But he let his emotion get the better of him. And he thought that Hillary had a good shot. And maybe she did. I don't remember the odds, but I remember that Trump was underestimated at the time, which is part of the reason why he won, is everyone underestimated him. So it's quite possibly he did too. And so when you look at these markets, the markets aren't always right. The wealthy people aren't always right. Right? It's a probability game. What's the probability? And generally, is the market set of probabilities. So this tool, just for this tool shows how the market is pricing the probabilities. So the market is pricing in a probability of a 50 basis point rate cut in September, 70%. That means 70% of the market agrees that this is what's going to happen. 30% of the market thinks it's only going to be 25, which means everyone thinks it's going to be lower. That's interesting, right? So the question you have to ask yourself is, do you think this is accurate or not? Now, if you're a savvy investor, you might look at it and say, well, there's no way this is correct. So I'm going to bet against this. And then, of course, you have to figure out how to bet against it, right? So instead of doing this, you might bet another way. This gets a little complicated, but the first step is to figure out, is the market accurately pricing in the future? If you don't think so, like at the end of last year, we didn't think so, then you would adjust according to that. If you think the market is right, then there's no real edge for you to make money there because the money has already been priced in by the market. And that's how markets work. So you have to look at for the inefficiencies or the inaccuracies or the big spread between the two as your opportunity to make money. That's how the institutional players make money. That's how the smart people make money. And you should be smart and you should make money that way too. Figuring out how to do it, that's a totally different game, and that's something that's not for everybody. That's a little bit harder to do, but I think if you take this step first, you can learn how to do the other one. But this is the key. Make sure you have this one right first. All right, so I have one more story. I'm gonna give it to Doug to wrap up. Let's see here. There was what was the other one I was going to talk? Oh, so I have a bone to pick with TI-CREF, and I'm going to caveat this by there's a piece of this which I'm not 100% sure because I'm going off the cuff. But there's a news story out by NBC that says investigations into TI-CREF pushing costly investment products on clients to cover losses elsewhere. This is according to a whistleblower reported by NBC News. So I'm not making this up. This is out with the news. Now, you might agree, like I do, the news is not always accurate, but something like this, you got a whistleblower. It's kind of like, all right, maybe they're making it up because the news no longer has responsibility for what they put out there, and they can cause people to get, presidential candidates to get shot at because of their irresponsibility. But that neither here nor there. This is whether it's true or not, I'm putting the blame on them because they're reporting it. So I'm just saying I'm reporting what they're reporting. So they said TI is trying to cover losses by pushing more costly products onto clients. Now, if I recall, and I might be inaccurate here, so I don't want to get sued, so I'm just caveating this. I might be inaccurate, but I know directionally I'm accurate. That I believe TI-CREF a bunch of years ago, maybe it's 3-4 years ago, got fined a big amount of fine for the same kind of activity in that they were pushing costly investment products on their clients. Now, the problem here is this. TI-CREF started as a teacher-centric organization to help teachers invest their money properly. And I think originally the premise was sound, and I think originally they did a good job. And then somewhere along the line, I forget when, but there's sometime maybe in the last 10, 15 years, they changed their business model and they become more of a for-profit organization where it was all about profit. It's kind of like Vanguard, who's I think is set up as a nonprofit, deciding, hey, we're going to try to milk everybody for every penny we got. Now, that in itself is a bit of a problem because you have a cadre of people who rely on and trust this organization for their best interest. And according to this story and the whistleblower, means that they're just basically looking at their bottom dollar and saying, we don't care about your people, our people. We're just going to say, screw you. We're going to do what we got to do. This is why people don't trust Wall Street, because of this, because people don't trust that Wall Street has their best interest in mind. And this is the kind of thing that should warrant a big fine because, and the problem is, and I'm not going to knock the SEC because I think there's more going on here than we can discern. But here's the problem. The Wall Street firms create a crime or a regulatory infraction or some sort of compliance issue. And let's say they make $1 billion. The SEC might fine them $100 million. Well, who cares? We just made $1 billion. $100 million is a cost of doing business. Unfortunately, that has been the history of fines on Wall Street for as long as I can remember. So the problem is there's no incentive for them to not to do this. Now, the incentive for them not to do this is, how much money did you make? Okay, 3x that is your penalty. That'll stop it right away. No one will ever commit another crime on Wall Street if that's the case, because there's no incentive for them to bend the rules. Politicians, you want to keep politicians in line? Say, hey, if you don't balance the budget, you're going to get taxed 100% of your net worth this year if you don't balance the budget. They'll balance the budget immediately. They'll find a way to do it because the incentive is aligned. We don't have aligned incentives in politics and on Wall Street in the way that it should if you want people to be upstanding people. When the incentives are aligned for them to actually break the rules and the penalty is so small that it makes sense to break the rules, I'm not saying they deliberately break them. I'm saying that it's easy for them to justify because they'll say, well, whatever, we'll just pay a fine and it'll be fine. So anyway, this is a bone I have to pick with Wall Street, and it hasn't changed, and I think it really needs to change. So, Doug, wrap us up here so we can take it home.
Jeez, I know we're all over the place. By the way, yeah. So TIAA CREF actually stands for the Teachers Insurance and Annuity Association. So it was definitely intended to be for the best an association. So in other words, it's supposed to be an advocacy on the behalf of teachers. Couple things here. You were mentioning about the again, whether or not the rate cuts are going to happen. Correlation to those rate cuts is that there, and again, everybody's got different opinions, different ways of looking at things, different economists, but there is a Fed economist named Claudia Sam, SAHM, who has a economic theory that a recession is likely if the unemployment rate 3-month average rises by 0.5% from its low. According to Bloomberg, Claudia Sam's theory has been triggered, and therefore, based on the 3-month average, under that particular metric, I guess we're in a recession. So we'll see how all of those things play out. Again, don't go run off there because of one way of looking at it, because there's lots of different ways to look at the charts. But that's the thing I wanted to go back to at the beginning of our conversation. We talked about, I think you said, if I had $1 million, did you, Kirk?
I feel like $1 million, Doug.
Feel like $1 million, but I thought you said you had it. But here, either way, there was a song in 1992. Do you remember what that song was called?
There were a lot of songs during that era, Doug.
If I
had $1 million
by the Bare Naked Ladies. So just to kind of have a little fun with that, I took a look. So the inflation rate from 1992, when that song came out, to 2023 was 2.56%. If we took that number right now and looked at what that would mean, and they were to write that song today based on that inflation, so we've got 32 years at 2.56%, it would mean they'd have to rename the song If I Had $2,245,000, which probably wouldn't make for a very good theme. But what I wanted to also point out to people, and I think this is really important to think about with inflation, right? So since 1992, $1 million at the inflation we experienced, according to the Fed, which we all know those numbers are wobbly, would now be $2.245 million that you need today for that same amount. But just since 2020, Kirk, guess how much the Fed assumes the average inflation has been just since 2020? I'll help you out. 4.5% average, including an 8% increase in last year, 2 years ago, and 4.1 last year. So just to kind of give people an understanding of the power of planning and the power of inflation, if you were to have that continued inflation rate, 4.5%, and they wrote their song today, 32 years from now, you would need to have $4 million just to live like today. And the reason that I'm bringing this up to wrap this up, because I know that we're over, is it's important for you to do planning, because that inflation will erode the purchasing power and the money that you have today. And most people don't plan for that risk. And that includes major purchases and liquidity needs you're going to need in the future, one of which is college. And I know you're facing that. In fact, Kirk, I think, has a chart. We could show it again another time about what the inflation rate has been on college and also the line item on textbooks. They are two of the greatest areas of inflationary increase. Now you look at housing, you look at all of these things, and ask yourself, when's the last time that you took a look and did a deep dive on understanding the impact of those risks to you personally. Is your financial house in order? Can it stay that way forever? If that's something you've been asking yourself, get a plan. Talk to Kirk, or if you're looking at the college side of things, you want to understand how to be prepared so that you don't have a shortfall for that liquidity. Check us out. Again, get a hold of Kirk, to get some questions if you have any questions for me. But I'm Douglas, Mergent College Advisors. We could certainly help you with some information there as well. But if you're not looking at inflation, risk, taxes, and all of these things, surprises are not a fun way to plan your financial future. Hope is not a plan.
Great. Thanks for coming on, Doug. And as we wrap it up here, one more spurious correlation. The number of mechanical drifters in Colorado correlates with the season wins for the Denver Broncos. So
I believe it. I believe that's true.
Yes. And actually, if I look at this spurious correlation, that means there's a high probability the Denver Broncos are going to win next year because the number of mechanical drifters in Colorado went up. So we got that to look forward to. So
hey, they won last year, so it's quite possible they're built for. It's got to be 100% correlated to that. I agree with this one, Kurt.
Yeah, I would say they have to win the next 5 to catch up. So good luck to them. Anyway, we're going to wrap it up. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kurt Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.